another good set of numbers this morning is from PN Gadgil. In the first quarter, margins have expanded sharply. Studded jewelry segment has also witnessed decent growth. Before we chat with the management, Mahima is putting the numbers in perspective.
Right. So, Tamanna, as you rightly mentioned, overall, if we exclude the refinery segment, the revenue growth stood at 30%. Margins have increased sharply, and we would want an understanding as to what has led to that kind of uptick. The other income has also gone up significantly, and same-store sales growth overall stood at around 8%. In terms of the numbers, EBITDA saw a growth of 71%, margins at 6.4 versus that of 3.8, and net profit up almost 96%. Operational metrics also look good. Overall uptick in both transaction volume as well as the average spending per visit has gone up. Transaction count also grew by 23%, and the average transaction value stood at around 93,000. 25% increase in footfall was also observed, and there is 92% conversion ratio from that. Studded jewelry increased by 41%. Of course, that's a 10% segment of overall revenue, but a good growth there as well, and possibly could be one of the reasons as to why margins have also seen some improvement on back of that. Plus, there is cost of raw materials that's reduced a tad bit. Wanted to understand as to what's happened there. And lastly, in terms of segmental performance, retail growth stood at 19%, franchisee growth at 108%, and e-commerce growth at 126%. So this is the overall view of how Q1 has panned out for PN Gadgil.
Okay, in fact, let's take some of those points across to Saurabh Gadgil. He's the CMD of PN Gadgil. Mr. Gadgil, very good morning to you, and thank you so much for speaking with us. Let's start with the margin number, which has seen robust growth. What has boosted this?
Good morning. Like we said before, the margin number is now only in retail, e-com and franchisee. There is no sale of B2B in this. So primarily margins are coming from the side of retail, which has shown very strong growth. We have been able to demonstrate good performance from the 9 stores we started last Navratri after the IPO, and store count has been good, and all the stores have received good footfalls. There has been good conversion steadily happening at over 90% across all the stores, and that has really been able to demonstrate good growth in terms of jewelry sales. And like we mentioned before, even the stud ratio has been on a rise, and we have seen 40% growth in the stud ratio, and that's something which has really helped us to pep the margins up. And as we have given the guidance before, the margins.
I think Saurabh, if I can call you Saurabh, I think what has also helped is your cost of raw materials have gone down. I'm wondering how that's happened when gold prices have gone up.
No, it's the whole set of numbers of the COGS, where we have been, as a publicly traded company, we have been 100% hedged now. So hedging has played an important role in ensuring that we don't lose, on the gold prices. And the cost of material is a combination of gold prices and the diamond prices. And as the diamond ratio goes up, the cost of the goods keep on coming down, and that is what has been seen in our financials here.
Your other income has also gone up substantially, and that has helped margins as well. I think your other income is up 6 times, if I'm not mistaken. What's the breakup over there?
So other income primarily is the income which we have earned from investments which were used for taking gold metal loans, and the other part is the franchisee income, the franchisee fee. So since franchisee also has seen a big uptick, there's a rise on both the fronts.
The first part is investment in what?
Investment in FDs, which were used as collateral for gold metal loans.
Okay, so those FDs have come off well, and franchises have also grown. What is the sort of trajectory you're seeing for the franchisee revenues?
So franchise revenues seem to be strong. We have projected that franchisee business should be around 12% of our entire business for the year. So we're targeting around 9,500 for the year, of which I think 1,000 crores should come from the franchisee side, and franchisee is a net income from us around 2.5–3%. So that's a segment which is going strong. And the other side is the revenue from our existing stores and e-com, which also have seen good footfall, good conversions. So I think overall we see that the margin which we have seen today, a PAT margin of 4%, should be we should really maintain that as we go throughout the year ahead.
This whole mix, Saurabh, which is where a lot of companies are coming out and saying that for them the LGDs are doing so well, and therefore that's helping them in their retail presence. It's almost as if Yes, it is a retail presence, but not as a jewelry company necessarily, because lab-grown diamonds, yes, the jewelry, but not high-end studded jewelry, right? Just trying to understand, when you think of the mix that you're putting in your store now versus what you might do over the course of the next 3 years, how do you go about thinking about this?
See, as of now, there's no inherent demand from our customers to really look at LGDs. So our stores do not stock LGDs as we speak. Our diamond growth has been strong, and we have been able to consistently command those prices for natural diamonds, and that's what the focus today lies in. LGDs is something which we believe that we don't know where the market is edging to. Will it be a fashion segment? Will it compete with fine jewelry? What will the positioning be? What will the pricing be? So I think the company right now is studying the market. We're waiting and watching. But 3 years is a long time. We really do not know if the market demands for it. There can be some a thought where we can enter into that. But as of now, we really feel that customers are preferring natural diamond. There's a huge demand for natural diamonds, and we are able to really cater to that. And we are, more than happy with the way the business on the diamond side is going.
Got it. Saurabh, over the course of the next 6 to 9 months or next 6 to 12 months, do you reckon the need for any kind of further capital raising in order to press on the accelerator for growth, be it via retail chain expansion or otherwise?
We have already sanctioned the QIB, in our in our board meeting and in the forthcoming AGM. So that's something which is going to be a need as per the SEBI requirement of diluting up to 75%. Currently, we are at 86% holding by the promoters, so we have to go down. So that's something which is on the agenda. There's no hard press need for it because the company itself is able to generate the cash for it to expand, and that's something which we have been constantly speaking that we'll be growing through internal accruals. But yes, the QIB, the dilution is something which will be on the cards, and that will further spruce up the growth in the coming months.
But Saurabh, sorry, if you indeed bringing the promoter holding down to 75, the capital doesn't go in the company, right? So when you do the nature of the QIP will be promoter diluting through OF, or rather just the promoter stake and the money going to the promoters, or an overall dilution which brings the money into the company.
It will be mostly overall dilution where the money comes back in the company and used for the expansion growth. So we are very clear from beginning that the money should come back in the company and used for growth. So that's what we will be aiming for. The timing is something which we don't know because it's not a pressing need. But yes, that's something which is on the mind and something which the shareholders are already approved for.
In terms of trends, Saurabh, what is the kind of gold exchange trend that you're seeing right now? And I found it interesting that you're saying no demand for lab-grown diamonds. Is that because you're not looking at that space at all, or is that something that you've observed seeing the market? Because there seems to be an increase in lab-grown diamond visibility as well. So 2 questions there.
So see, as far as the gold trend goes, with the high prices rising in the market today, there are 2 things which are happening. One is that there is still a huge demand for lightweight diamond, lightweight gold jewelry, casual shopping, which is a demand which is on the rise. When it comes to serious shopping, wedding shopping, festive shopping, old gold exchange is something which is today around 40-45%, and I think that's something which will remain as the prices look steady, and the people are swapping old gold for new jewelry. But for a jewelry company, that's it's a good thing because our income comes from making charges. So as long as people are making new jewelry, I think the margin should be intact. When it comes to lab-grown diamonds, it's something which we track, but there is no, like I mentioned before, there is no demand from the consumers, and that's an important factor for us because we have to cater to our consumer demand. And if the consumers start demanding lab-grown diamond, if there's an inherent push towards lab-grown diamonds, the company, will look at that aspect. But as of now, the natural demand is very strong, and I think consumers today are looking at fine jewelry with only natural diamonds. The segment of fashion, the segment of casual jewelry is where lab-grown diamonds may take a place. But from the point of view of PNG, there is no inherent demand for the consumers as yet.